FHA 203K versus HomeStyle versus VA Renovation. Which wins for a fixer-upper? So if you mention doing a renovation mortgage to 10 different real estate agents or mortgage loan officers, 9 of them will immediately tell you, don't do it. The timeline takes too long, the paperwork is a complete nightmare, and the deal will die in escrow. Do you want to know the real reason they say that? It's because they do not understand the underlying guidelines and that they have been buried by uncertified contractors or distant volume-based digital tech platforms that try to manage a complex construction site through a zip code algorithm. For National Home Buyers Month, we are throwing out those myths and exposing the data. Today, I'm giving you an absolute masterclass comparing the 4 heavyweights of renovation lending: FHA 203K, Fannie Mae HomeStyle, Freddie Mac CHOICERenovation, and the VA Renovation loan. I am going to show you exactly when to use each, where the hidden traps are located, and how to structure them to close seamlessly. So hit that like button and let's dive straight into the matrix. Let's start with the most widely used product on the market, the FHA 203K. This is the undisputed king of flexible underwriting. If your credit profile is less than perfect, down to say a 580 FICO score, the FHA framework is your best path forward, requiring a flat 3.5% down payment baseline, calculated off the purchase price plus total renovation costs. It handles everything from a streamlined cosmetic update under the $75,000 limited program up to a massive structural addition and multifamily overhauls. But it carries 3 strict limitations. You cannot complete luxury upgrades like an outdoor swimming pool. It mandates a lifelong monthly mortgage insurance premium that never drops off. And it is limited entirely to owners occupied primary residence. If you want to smash past those rigid government restrictions, cancel your monthly mortgage insurance in entirety, or buy a property as pure investment, then you must shift your focus to a conventional board immediately. The conventional powerhouse, HomeStyle and Choice. If you possess a credit score of 620 or higher, conventional options, Fannie Mae HomeStyle and Freddie Mac CHOICERenovation, completely outpace FHA flexibility. Want to install a brand new in-ground swimming pool, a luxury outdoor kitchen, or even a detached garage? Conventional guidelines fully authorize it. Want to purchase a renovation property as pure wealth-generating asset? Unlike FHA, HomeStyle allow you to buy and rehabilitate a 1-unit investment property and second homes. Furthermore, Fannie Mae recently introduced a massive operational shift that expands the threshold for skipping extensive oversight on non-structural files up to $50,000. But remember, the second your project exceeds $50,000 or involve moving structural load-bearing headers, a HUD 203K consultant must be formally assigned by the lender to manage the escrow and protect the bank from risk. Now, the good news. If you're a military veteran or active duty service member, listen to me very carefully. The VA renovation loan sounds like an ultimate zero-down dream on paper, but it carries a hidden operational barrier that stalls out almost every project on day one if your team isn't prepared. The military loophole. VA renovations drags. For our veterans, the VA renovation loans offer an incredible financial baseline: 100% financing, 0% down payment, and absolutely no monthly private mortgage insurance. But here's the critical operational catch that lenders rarely explain. Unlike FHA or conventional loans, that authorize an advance material draw at closing of up to 50%. So the builder can pull permits to secure lumber. The VA framework strictly prohibits upfront materials draw. The initial draw at closing table is $0. Your contractor must possess the independent working capital to fund the start of construction completely out of pocket. And they are paid later via subsidence milestone draws based on physical percentage of completion. If you hire a small local contractor who relies on deposit checks to buy raw material, your project will freeze on day one. Furthermore, the VA mandates a strict fast-track 120-day construction clock from closing, and no major structural allocations are permitted. Capital independence versus automation and closing. Whether you choose the FHA, conventional, or VA renovation path, controlling the capital is what keeps general contractors on the site and the deal on schedule. That is why smart underwriting departments mandates a structured draw inspection schedule, standardized at $375 per draw. As your registered HUD consultant, I physically visit the property site at every milestone, verify structural and building code compliance on the ground, and gather unconditional lien waivers before releasing the capital to the builder. So do not let a faceless digital app or a remote web dashboard estimate your construction using generalized zip code metadata. An algorithm cannot check structural headers, verify subcontractors, lien waivers, or spot hidden code violations behind your drywall. So protect your equity with a local, boots on the ground, professional advocate. So if you like this information, please head over to myrehabconsultant.com right now and download the Ultimate Renovation Loan Checklist for home buyers and realtors. It integrates every single rule, timeline milestones, and draw process we discussed today into a single scannable sheet you can use on your phone through your next property walkthrough. So just remember, this information is valuable. Please hit that like button. So let's protect your closing, and I'll see you on the next inspection.